Why price is changing. A multidimensional explanation of why price moves and chart patterns form. I'm an engineer. I work with data and systems, which means I spend my time making sense of numbers in complex environments. I approach markets the same way, with logic, curiosity, and a deep respect for uncertainty. Markets aren't predictable machines. They're complex, adaptive, and often non-deterministic. That's why this channel takes a holistic approach. We talk about market mechanics, psychology, macroeconomics, geopolitics, and technology, all in one place. I don't create content to follow trends or repeat what others say. I create it to organize my own thinking and to share ideas that are worth sharing. I'm not a crypto parrot. I don't recycle surface-level content like many YouTubers do. I go deeper into structure, cause, and meaning. Take a look at this chart. Price is flat for 27 minutes, then in 5 minutes drops by $450 just to reverse and gain $660 in 6 minutes. What exactly makes it change? Who decides that? Why does it go down at one moment and up the next? What changed? Even if something changed, why price reacted this exact way? The mechanism that moves price is not a mystery. It's clearly defined, based on how exchanges work. It enables every trade, and it's the backbone of all modern markets. And yet, especially on YouTube, this core mechanism is almost never explained clearly. People talk about price without understanding what actually moves it. In this mini-series, we'll change that. I'll take you step by step through the actual mechanics behind price movement, starting from the foundation. If that format sounds good to you, here's what to expect. First, I'll shortly walk you through a few absolute basics, explaining bid and ask mechanism, the engine behind price movement. Do not worry, it will not be another YouTube video about bid and ask. It will be much more. And even if you've never looked into it, you'll understand what matters. Then, we'll tackle some of the most persistent myths about how price moves. Because unless we clear those out, they'll keep distorting how we see the market. Once that's done, we'll start rebuilding. But not with strategies or signals. We'll rebuild your mental model of the market. I'll invite you to see the market as a multidimensional space where aspects like macroeconomics, fundamentals, psychology, and price structure exist as interacting dimensions. Not causes, but context. And once that foundation is in place, we'll return to the bid and ask mechanism, this time in full depth. We'll break down how it actually drives price, how it creates chart patterns, and how it shapes our understanding of trends, reversals, and structure. That's the journey. So without further ado, let's begin. This content is for educational purposes only. It's not financial advice. Let's get started. Imagine that we're on an exchange, a digital marketplace where people come to trade. You're looking at an asset and you see a price. But what exactly is that price? It's not set by a government. It's not chosen by the exchange. It's the result of an agreement between buyers and sellers. That agreement creates the trade, and the agreed number becomes the price. The latest point on the chart shows the current price, the most recent agreement between a buyer and a seller. But the chart as a whole is much more than just numbers. It's a living history of agreements, a visual record of how people acted under uncertainty. Behind every price point, there's intent, strategy, hesitation, and sometimes urgency or pressure. This isn't just data. It's human behavior plotted over time. But knowing how these prices are recorded is only part of the story. What really matters is how you interact with them right now. Here's something important. That price is not necessarily the price you'll pay or receive. Usually, if you want to buy now, you'll pay a bit more. If you want to sell now, you'll usually get a bit less. You might think, well, maybe the exchange makes money from that difference, like a currency exchange booth with a buy-sell spread as their profit. But that's not how this works. An exchange isn't a dealer. You're not trading with the exchange. You're trading with other people or institutions. Let's call them market participants. The exchange is not your counterparty. It's just a system, a matching engine that connects buyers and sellers directly without taking a position of its own. Just like a market square in an old city, it provides the space, the rules, and the records. But the price is always set by the participants. At any given moment, the market is full of participants. Some want to buy, others want to sell. It doesn't matter who they are. They might be large institutions or individual traders, but they all play by the same rules. You can group participants in two ways. First, by what they want to do, buy or sell, and second, by how they want to do it, passively or aggressively. A passive participant sets a price and waits. They place a limit order. I'll buy, but only if the price drops to $1.85. Or I'll sell, but only if the price rises to $2.10. They're patient. They wait for someone else to meet their price. An aggressive participant wants to act now. They look at what's currently offered and say, I'll take it. They cross the spread, accepting the best available price on the other side. That's what triggers a trade and moves the price. Without someone crossing the spread, nothing happens. There's just a list of standing offers, buyers waiting below, sellers waiting above. Price only moves when someone says, I'll pay your price, or I'll take your offer. That agreement is what turns potential into action and updates the chart. This is just a simplified version of the bid and ask mechanism. I do not want to get more technical at this point, as there is something more urgent. I will return to this mechanism itself and explain how it works in detail. But now, what really matters are the consequences of this mechanism. I will explain to you how this mechanism plays with some other concepts, like volume, liquidity, and market participant intent, to form patterns on the price chart. And it will be great. But first, we have to bust some myths and rebuild your understanding of the markets. A common myth says, price goes up because people are buying. This is one of the most dangerous beliefs in trading. It feeds FOMO, the fear of missing out. Rising prices, combined with euphoric narratives, create the illusion that all market participants are in agreement, that everyone is rushing in to buy. But that's simply not true, because for every buyer, there is a seller. Always. If someone bought 5 boxes, someone else sold them. The number of people on each side might differ, but the volume traded is always equal. So when price goes up and volume is high, it doesn't mean buyers are stronger. It means sellers were in control. They had something others wanted badly enough to pay more. More buying doesn't push price up. More aggressive buying does. It's not the quantity, it's the urgency. That's what moves price. That's why in euphoric moments, price can explode upward. And in panic, it collapses just as fast. There's also this idea that buyers are in control. But that's a misunderstanding. If price is rising, it's not because buyers are in control. It means sellers are not accepting current prices anymore. They are only willing to transact at higher levels. Buyers, on the other hand, must adjust and accept less favorable terms to complete their trades. In that situation, it's the sellers who have the advantage. They are the ones capturing more value as the price moves up, not the buyers. So why do these myths still exist? Because as humans, we love to explain things, even if we don't fully understand them. We look at what happened, then we invent the reason afterward. That's not logic. That's narrative bias. Let me show you what I mean, with a simple analogy involving car movement. Why does a car move? Because someone is driving it? Because people need transportation? Because fuel is being burned? Because there's a green light? All of these answers sound reasonable, but none of them describe the mechanism. People need transportation may explain why cars were invented, but not what makes them move. The driver controls direction, but doesn't generate motion. Fuel is necessary, but it's just the input, not the motion itself. Green lights allow movement, but don't cause it. A car moves because of its engine, transmission, and steering system. That's the real mechanism. Everything else is context. And the same thing happens in markets. We often mistake context for cause. The engine behind price movement is the bid and ask mechanism. The engine behind market myths is confusion between cause and effect. That's what we'll explore next. Let's move on to another myth, one that sounds sophisticated, but can be just as misleading. The idea that price moves because of supply and demand. You've heard it everywhere, in books, on YouTube, even from analysts on TV. And it makes you feel like you understand something deeper, like you're on the inside, like you've unlocked how markets work. But here's the problem. It's just a model, not a law. And like any model, it only works under certain assumptions. The reality is often more complex, especially in crypto markets, where price can lead and supply or demand adjust afterward. Even economists can't agree. Is price the cause or the effect? This is where it gets tricky. And this is where the Dunning-Kruger effect kicks in. The less you know, the more confident you become. You read a simplified chart in a trading book, and suddenly you feel like you understand more than people who've studied markets for decades. But maybe, just maybe, it's not that simple. Maybe price isn't determined by supply and demand. Maybe price is information, and demand is just how people respond to it. Let's look at what different schools of economics have to say. So, if even the idea of supply and demand isn't settled, what do the experts actually believe? Let's take a look at how different schools of economic thought view cause and effect in markets. First, the neoclassical school. This is the textbook version most people learn. It says price is determined at the intersection of supply and demand curves. Price is the result, not the cause. In this view, supply and demand move first, and price follows. Then we have the Austrian school. Here, price isn't just a result. It's a signal. It guides human action. In their framework, price can actually trigger supply or demand reactions. So the direction of influence flips, at least partially. Finally, we have behavioral economics and market microstructure. This school argues that markets are dynamic, not static. People don't just respond to supply and demand. They react to price in real time, based on fear, greed, context, and expectations. Here, price and behavior influence each other in a feedback loop. And here's the key point. These aren't just theoretical differences. They lead to completely different interpretations of what's happening on a chart. If you still think that supply and demand determine price, you're stuck in just one model. But once you realize that price can move first, and that supply and demand might adjust afterward, you start to see the market for what it really is, a dynamic, adaptive system. Let's see what this means in practice. Scenario 1. Travel restrictions during the pandemic. Oil supply stayed the same. You can't just shut off crude oil extraction. But demand collapsed like never before. With nowhere to store the excess oil, producers were forced to sell at any price. That's why oil prices dropped below zero. The cause was demand destruction. Price was the result. Scenario 2. The war in Ukraine. This time, it was supply that dropped, not demand. Two of the world's largest wheat exporters went to war. Less supply, same demand, and prices spiked. Again, the cause was fundamental. The price followed. Scenario 3. The 2020 lockdown. Everyone needed electronics for remote work and entertainment. Demand for laptops, webcams, and consoles exploded. But chip production couldn't keep up. Supply stayed flat, demand soared. And so did prices. In all three cases, the change in price was a reaction to real-world necessity. This is exactly how neoclassical economics sees the world. Price is an effect, not a cause. Scenario 4. In late 2017, Bitcoin hit nearly $20,000. Retail investors who had been holding for years were suddenly looking at life-changing gains. Many started selling, not because fundamentals changed, but because the price looked good enough to sell. In this case, the rising price itself created supply. Exactly what the Austrian school suggests. Price can trigger behavior. It can activate supply or discourage demand. Now look at scenario 5. In March 2020, global markets crashed. Bitcoin dropped below $4,000. Stocks collapsed. Liquidity dried up. But smart investors saw an opportunity. Not because earnings improved, but because prices were low. The drop itself attracted demand. It wasn't about valuation models or macro forecasts. It was just cheap. This again fits the Austrian view. Price moves first. Behavior follows. Now consider scenario 6, early 2021. GameStop stock explodes. Not because of earnings, not because of news, but simply because price started rising fast. People jumped in, fearing they'd miss out. Demand was created by the price action itself. That's not fundamental value. That's momentum. That's hype. That's crowd psychology. It's a perfect example of the feedback loop described in behavioral economics. The market reacts to itself, and in that kind of loop, price becomes both cause and effect. Back to scenario 5. How do we actually know that price dropped first and that the drop itself triggered demand? We can see it in the volume profile. During the initial sell-off, there was very little volume traded. Price moved, but not because there was overwhelming supply. It moved because the bid and ask mechanism was activated by aggressive sellers in thin liquidity. Stop losses were triggered, orders got cleared, but there were no strong buyers yet. Only after the price dropped low enough did opportunistic participants begin to step in. And how do we know they were experienced traders? Because the price didn't snap back instantly. There was no V-shaped recovery. Buyers accumulated slowly at lower levels. And the high volume activity we see, it's concentrated near the bottom, not during the panic move. That's a key signal. And we'll explore many more like this in upcoming episodes. Because here, we don't just follow market myths, we break them down and rebuild understanding from the ground up. Now let's dive into an important myth number 3. Price moves more when traded volume increases. Or high volume means smart money are involved. This is misleading and can really confuse us. Let's take a closer look at the data in chart 1 and 2. We see 2 events. The first, with 500,000 units traded, resulted in just a 2.5% price move. The second, with only 45,000 units, caused a 16% move. So, what does this tell us? High volume does not always mean significant price movement. In fact, it can indicate that professional traders are carefully accumulating positions without making drastic changes in price. On the other hand, a large price movement on low volume often signals a lack of liquidity, which can easily mislead retail traders. Remember, always compare volume to historical values for context. Volume doesn't have an absolute meaning. It's relative. Sometimes what looks like high volume today is actually normal when viewed in context. And here's something to think about. Can you find periods like this on your favorite charts, where volume was high, price barely moved, and then something big happened? Now, here's the bigger issue. Sometimes valuable theories like Wyckoff's method become harmful because of how they're misinterpreted, especially on YouTube. The idea that smart money leaves a trace in volume gets reduced to a simplistic heuristic, like big volume equals big player. But markets don't work like that. Volume tells you how much was traded, but not why. and not by whom. And without context, it can lead you straight into a trap. So, what should we take away from all this? First, high volume with little price movement can be a sign of professional accumulation. Strong hands building positions quietly without moving the market. Second, high volume with a large price move often signals panic or euphoria. That's when emotion enters the market and volatility spikes. Third, low volume with the large price movement usually means there's no real liquidity. The market moves easily, but not necessarily meaningfully. And finally, low volume with little price change often just means there's no interest. A dead project, no activity. Always remember, volume is relative. Compare it to historical values to make sense of what you're seeing. And most importantly, don't reduce this to a simple heuristic. Not every big volume spike means smart money. Not every drop means they're gone. These are tools, and like any tool, they can help or hurt, depending on how you use them. We've just talked about smart money, the kind of capital that acts with purpose, precision, and adapts its strategy to position size, time constraints, and defined goals. But smart money doesn't operate in a vacuum. It competes with other smart money. And when capital meets capital, there are no guarantees. Every edge depends on what others are doing. So now let's shift gears. If smart traders can't rely on fixed outcomes, what about really smart individuals? The ones who build models, who write economic theory, who win Nobel Prizes. Have they cracked the code? Do they walk through financial markets with total clarity, seeing structure where others see chaos? Or is there something deeper going on? Let's find out. In 2013, the Nobel Prize in Economics was awarded to three men, including Eugene Fama and Robert Shiller, for defending seemingly opposite views about how markets work. Eugene Fama was honored for developing the efficient market hypothesis. He believed that markets are rational, that prices always reflect all available information, and that future price changes are unpredictable because new information appears at random. That's why the idea of the random walk became central to his theory. If no one can predict the news, no one can predict the price. Robert Shiller, on the other hand, argued something different. That markets are often irrational, that prices don't just follow facts, they're shaped by fear, greed, and stories, by patterns of human behavior. These views may seem contradictory, and they are, but they also work together, like two sides of the same coin, like yin and yang. When the market is calm, liquid, and stable, Fama's theory tends to dominate. Information flows, prices adjust, and prediction becomes nearly impossible. But in times of panic, hype, or bubbles, Shiller's world takes over. Emotion distorts the signal, and irrational behavior creates opportunity or disaster. Neither theory explains everything, but together they help us understand more. And believing in only one side while ignoring the other was yet another myth. Markets aren't one-dimensional. They shift, they evolve, and so must our understanding. But wait, isn't investing ultimately about predicting the future? Not reacting to news and not getting lost in emotion, but positioning for what's coming? Yes, that's true. Many investment theories are valid, but each one describes only a part of the reality, never the whole. Each one opens up an entirely different dimension of investing, one where many successful investors thrive. We'll come back to that later, because for now, I wanted to break a myth, the myth that there is one theory, one framework, that can fully explain the market. In reality, markets are more like complex physical systems, where different models describe behavior in different dimensions of space. And only when you combine those dimensions into one equation can you even begin to understand the whole. The problem is that equation is dynamic. It changes over time. and it's much harder to solve than most people want to admit. At the heart of the efficient market hypothesis lies another idea, a theory called the random walk. It's not new. In fact, the concept dates back to the early 1900s. But it became widely known among retail investors after the release of one popular book, A Random Walk Down Wall Street. In that book, the author, a respected academic, tries to explain why chart patterns are meaningless. He writes, "I asked each of my students to flip a coin and record the results. Heads meant the stock went up a point. Tails, it went down a point. After a series of flips, we charted the results. The resulting graph looked remarkably like a real stock chart, complete with trends and patterns." He presents this as proof that what you see on a chart can emerge from pure randomness, and maybe that sounds convincing. But on the next slide, I hope to show you why this interpretation is a dangerous oversimplification. And I say that because I tested it myself. So if you ever ask, how can I trust information on YouTube? Well, let's be honest, even the most famous books contain ideas that collapse under simple scrutiny. My only advice? Never eat what smells bad, whether it comes from a street food truck or a fancy restaurant. Let's put that theory to the test. This simulation, I built it myself. On the left, you see a chart created from 15,000 coin tosses. Each toss moves the price up or down by 1%. The result? It moves, yes, but it doesn't behave like a real market. There are no consolidation zones, no sideways movement, no calm before a breakout, no shifts in volatility, no reactions to key levels, no hesitation, no panic, no rhythm. Just a slow, smooth, structureless decay. It lacks everything that gives price charts their unique character. You could even say, if any real-world asset looked like this, it's probably a scam, with no interest or liquidity. And yet, this is the type of example used in respected books to debunk chart patterns. So here's the first lesson. Even respected books can be misleading. Don't outsource your thinking. Be skeptical. Always check for yourself. Now, let's flip the script. On the right, I created a second chart, but this one is the opposite of random. It's 100% deterministic. Every move is predefined, based on the digits of pi. Odd digit, price goes up. Even digit, price goes down. The result? A chart that looks realistic. There are swings, structure, rhythm. It feels like a market, so much so that some people believe PAS holds hidden truths about price. That market behavior is secretly encoded in mathematics. But that's just as misguided as believing in coin flips. With enough imagination, people will find patterns in anything. Golden ratios, fractals, sacred geometry. Pi is beautiful in math, but in finance, it means nothing. We'll return to this later when we dive into the myths of technical analysis, because that's where many of these illusions live, and where they become dangerously seductive. Markets are often described as a game. And sure, they have elements of competition. But they're not a game in the traditional sense. Not everyone is here to play. Markets exist to finance companies, to trade real goods, to manage risk. Every transaction has two sides, and both agree to the price. Some want to profit, some want to hedge. Others get paid for improving the mechanics of the system itself. Liquidity, efficiency, speed. There can be many winners. It's not always about beating others. Sometimes the challenge is beating yourself. So no, financial markets are not one single game. They're more like a multi-sport arena where many disciplines are played at once. In some events, bots are unbeatable, like in chess, where all the information is visible and the rules are fixed. In others, like poker, bots are very strong, but you can still win a few hands. They don't take all the chips off the table. But the best analogy, it's an obstacle course through an unknown terrain. A race with shifting rules, changing maps, and surprises along the way. In that kind of game, everyone who adapts, Who stays focused and who keeps moving forward can find a reward at the end. We'll talk more about bots later. For now, just remember this. Don't try to beat them in a game you can't win. And don't trust a $10 subscription to do the job for you. If a bot really worked, it wouldn't need your money. We've just debunked a few myths. But really, it's only the tip of the iceberg. I chose to make this first episode about exposing myths, because as long as we believe in them, they push the truth aside. They distort how we see the market. They block real understanding. Socrates knew that. He challenged the false beliefs of his time and paid the ultimate price for it. This material might not have been easy, but it wasn't meant to be entertaining. It's meant for people who want to learn. People who want to understand, not just believe. If you feel like something didn't click, watch it again. Or just revisit the parts that spoke to you most. That's how learning works. There are thousands of channels on YouTube repeating the same old investing mantras, selling false certainty and empty motivation. But here, we're building something different, something deeper, step by step. In the next episode, we'll look at the context in which price moves. We'll explore how news flows affect perception, how emotions shape reactions, what fundamental analysis really means, and how to use technical analysis without falling into its traps. We'll treat markets as living systems driven by both data and human narrative. And in part 3, we'll go deeper into market structure itself. I'll show you real price phenomena, how levels are formed and tested, how the bid-ask mechanism creates movement, how price arbitrage works, and why certain patterns repeat even when everything else seems to change. It's going to be a long journey. But if you've made it this far, you're ready.